Basically, risk management is a system for adjusting the amount of capital you have exposed at any given time. It's controlled by the number of positions you have on, the sizes of each of those positions, and where your stops are for each of those positions. So how do we lower that risk? Say we start a corrective environment like a few weeks ago. How do we lower the risk given that those are the three factors? Well, we can take less trades. We can decrease the total number of positions we have on our books. We can decrease the starter position size that we're taking on new positions or the overall dollar invested. And we can tighten up the stops and tighten up the sell points, become more aggressive with selling, lock down gains, faster when we do have them. These are all three different ways that we can go ahead and lower risk if we would like to. If the market environment shifts, market feedback, maybe 7 out of your last 10 trades have been losers, that's a sign that, hey, maybe I want to go ahead and lower risk. Stop losses are your insurance. They're basically the cost of doing business. And a way of thinking about it is it's your ticket to actually buy a ticket to actually place the trade. You're paying your stop loss in order to actually enter the trade and look to participate in a strong trend. And the best thing about this is, and way of thinking about it, is you get to decide exactly how much you pay by defining your risk based on the stop loss as well as the position size itself. What about gap downs? How do we manage risk here? Gap downs will happen. I think the key thing here is we have to manage risk in real time. A stock could just as easily gap down and keep going, and it breaks below the base, and then it breaks a 200 SMA, and then again, you're an investor when you should have been a trader. You got to take your loss when it's as small as possible. Taking small losses is mentally just, an easier thing to do. Small losses do sting, but large losses are devastating and really hurt your confidence, which is a huge part of trading. A big loss, you'll have to take a few days, take a week. If it's a really big one, take a few months off to really be right again mentally and be ready to get back in the game and, work your way back up to where you are. So defining a stop loss. First, when you've got a potential setup, check your entry point and logical technical stop, calculate the percent distance before them, or ADRs if you like to think about it in that way, to account for volatility. Know the dollar amount of your portfolio you want to invest, and then simply multiply this dollar amount by your stop and check if you're taking up too much additional portfolio risk to take the trade. If the total risk is going to be 1% of your account and you don't want to take that on a single trade, or you don't want to add that to your total open risk, then you either have to not take the trade, choose a different stop, or lower the position size. It's as clear as that. Well, let's go ahead and get started. So welcome everybody to the next Trader's Handbook webinar. This is a series of webinars that we're doing along with the release of our book, which will be on May 27th, the Trader's Handbook. And each chapter kind of covers one of these different concepts. And to go along with the book, we thought it'd be great to kind of talk through each concept and aspect of building a trading system and go into more detail, give more examples. And I think these are a great accompaniment to the book. We're about halfway through now. After this week, we will be halfway through, but there's still a lot to cover. Market cycles will be a really good one, especially considering the current conditions. So if you haven't yet and want to be the first to know with all these webinars, go ahead and register for the free interest list, and you'll be the first to know about all the different resources as well as future upcoming webinars. Here's the QR code to join that Trader's waitlist, Trader's Handbook waitlist. You can scan that QR code just right there to join. Again, it's 100% free. And in addition to registering for the webinars, we'll also be sending out different resources. Tomorrow, I'll be sending out a stop loss setting guide. So in addition to today's webinar, I'll be expanding on, how I like to set stops in a free article that I'll send by email tomorrow. So definitely go ahead and check this out. You'll receive all the other previous ones once you sign up to this Trader's Handbook waitlist. So don't feel like you missed out if you didn't sign up already to receive these ones. You'll basically receive one a day as soon as you sign up. So here again is that QR code. If you haven't already, go ahead and register there, and I'll give it just 1 minute to allow you guys just a little bit of time to do that. All right. And yeah, I see a question actually from Miles in the chat. You can watch all the previous webinars on YouTube. We created a playlist on our channel called Trader's Handbook Webinars. You should be able to find those there. And this one itself, as soon as we're done with the live stream, you'll be able to go ahead and watch it back as many times as you'd like to. But previously, we've talked, of course, about entry tactics, trading foundations, edges, and setups. So if you haven't watched those previous ones, definitely recommend checking it out. All right. So let's go ahead and get into today's webinar. So welcome again, once again, everybody. Today we'll be focusing on risk management and stop losses, a really key chapter, both from a high level, portfolio level, as well as setting individual stops on different positions. We want to start with this quote from William O'Neill. Of course, many of you know him, the founder of Can Slim. Basically, this kind of sums everything up in terms of why we should be setting stop losses and focusing on risk management in the first place. He says, buying a stock without knowing when or why you should sell it is like buying a car with no brakes, or being in a boat with no life preservers, or taking flying lessons that teach you how to take off, but not how to land. Basically, it's a key part of the trading equation and really essential to allow us to trade for decades. Here's the agenda today. We've got a lot to cover. First, we'll talk about kind of, again, from a high level, what is risk management, stop losses, our tickets to trade, our insurance as well, what are tight and logical stops, what does that actually mean? Then we'll discuss some guidelines for both swing trading and position trading. It's a little bit different. Of course, swing trading is a little bit faster, tighter stops, faster sell rules, and position trading, you want to kind of be a little bit more hands-off, let the position work. You'll widen those stops a little bit to make sure that you don't get choked off of a trade. And these guidelines also be really good for a lot of you folks who probably, do this part-time or work a full-time job. And again, want to be a little bit more hands-off. These guidelines should help you with that. Then we'll discuss position sizing, portfolio level risk management, as I mentioned, and also, I think this is really relevant, lowering and raising risk based on market health, how you can do that, what are the 3 different factors, different gears that you can adjust to do that, and both lower and raise risk in accordance to whether we're in an uptrend or a downtrend. So these are a few questions that likely you guys have about risk management. We'll be answering a lot of them today, as well as the position management ones in the next webinar on this upcoming Saturday. Where do I put my stop? When should I sell? How do I manage risk? What does risk management even mean? We hear that term, shouted about a bunch of times, but what does that actually mean? How do we practically go about doing it? When do I take a profit? When do I move up my stop? All these questions we'll talk about and address in today's webinar. All right, so first, starting from a very high level perspective, what is risk management? Basically, risk management is a system for adjusting the amount of capital you have exposed at any given time. And it's controlled by 3 factors, which we'll get into in even more detail in the upcoming slides. It's controlled by the number of positions you have on, the sizes of each of those positions, and where your stops are for each of those positions, / where you will exit. If you have a gain, for instance, the point where you would exit may be an undercut of the 50 SMA, the 21 EMA, the prior week's low. Basically, it's controlled by where your exit would be if the stock starts pulling back. And basically, you need to put on risk to potentially profit from winning trades. So I think that's an important part that we do want to emphasize today. We're talking about managing risk, not eliminating completely. That's impossible. And to actually profit and make good trades, we have to put on risk. And we'll talk about how to manage that risk to make sure that our losers are smaller than our profits. And like I say here, the key is to develop a risk management system that keeps our losses small relative to your profits over time. Again, we're always talking about a series of 50, 100, 500, 1,000 trades that you'll make over the course of your trading career. We're not just focusing on one trade, but the key is to think long-term and think over a series of trades. So defining your risk, this just kind of sums it up really nicely. I think you should always be aware of your total open risk and drawdown if all stocks hit their stop losses. We'll show you guys how to calculate that, and that will be part of the quiz. So make sure you guys pay attention for that. And we want to emphasize that you are in complete control of how much your capital is at risk at any given time. And we'll talk about the 3 different factors that you can adjust to control how much total open risk you have. And basically, you want to think of this like managing a business, because that's what trading is. We don't want to just do this for fun or it can be fun and the process is very fun, but we want to make profit over time. That's our goal. We want to compound. And we always want to be aware of the total open risk and break even line so we can sleep at night and make sure we're managing our system properly. So that gets us into our first kind of high level topic, total open risk. So what is total open risk? Total open risk is basically the percentage of your portfolio that you would lose if all your stocks hit your sell points, whether that's stop losses or, again, if it breaks below moving average and that's your sell rule, that would be your sell point. And we're going to walk through the math here and pay special attention, like I said, because we'll be doing a giveaway related to being able to do this math. It's pretty easy, but we'll see, who gets the answer right first. But basically, the process to calculate your total open risk is, first things first, per position, multiply the dollar amount invested by the percent distance from your stop. So for instance, if you have $10,000 invested into a particular symbol, you multiply that by a 4% stop, and that gives you the dollar amount that you have at risk for that position, which in this case on a $10,000 position, a 4% stop would be $400 at risk. Then, like I said, do this for each position. And then you want to sum up all those different individual position risks that you have. So position 1, if that's $400, plus position 2, $200, position 3, $600, position 4, $700, and the total in this example ends up being $1,900. And this would be your dollar drawdown if all your stocks were stopped out, or you sell all your stocks at your predetermined points. Then to calculate the percentage total open risk, what you have to do is divide this dollar drawdown, the dollar open risk, by the amount your total account is. So in this example, we're using a 50K account. It'd be $1,900 divided by 50K times 100, and you basically have 3.8% total open risk. So this is how you calculate this, and this would be your drawdown if everything was stopped out or sold in your account. So to kind of put this in perspective, we'll put you guys to work right away. Let's say you have an account size of $100,000. These are your positions. You've got deep, view, TLDV, and RM. These are the position sizes right here, 25K, 15K, 10K, and 25K again. These are their stops. I want you guys in the chat right now to do a little bit of math and calculate what is the total open risk, both in dollar amounts and percentage. And we'll see who gets it correctly. And I'll show the answer and walk through this example in just a minute. And Ryan, while we're doing this, is there anything you want to add about risk management, why it's important while they're doing some math over here?
Yeah, I would say, a lot of traders are trading part-time and they're trading with capital that they are willing to lose, which can be actually, it's hard to treat it like a business when you're doing that. And you kind of, if the money grows, great. If it doesn't, great. And that type of situation, you learn the hard way, or you eventually just give up and move on because you feel like the stock market was, a slot machine that doesn't pay you back, right? And most slot machines don't. So that's why risk management becomes a topic that the great ones speak about very, strongly, that without this, you cannot be a consistently profitable trader. So knowing your stops, knowing your exit plan before you intend to buy, or placing an order to buy without knowing where you will accept that particular loss, it will result you in, almost never being successful if you don't know your exit plan. So it's again one of those things as we cover the different pillars throughout the 10 or 11 webinars that we're doing. Each one of them is a core kind of value or initiative that you have to take up so that you can, make it part of your business plan, right?
Yep.
So it's not that one component was more important than the other. All of them have to work together for you to create a trading system, and it's no different for risk management. So
Yeah, and risk management, I think, is one of the most important concepts to stay trading and make sure you preserve your account over time. I was lucky enough that Dr. Wish emphasizes from the early days of the class where I first learned how to trade. And part of our final project was, we had a dummy account of 100K that we traded in a class challenge. And for every trade where we had a loss over $500, we had to dissect that trade, analyze what went right, what went wrong, and basically, come up with a system, a reason why we will never lose again, greater than $500. So I think that's a great, advice for everybody out there. Come up with a dollar amount that you don't want to risk more than that or lose more than that on a trade. And then for every trade that you risk more than that or lose more than that, you have to analyze and dissect and do a lot of post-analysis to determine what went right, what went wrong. So I think that's a good exercise for you folks. And it looks like we've got some great answers in the chat. Most of you guys already got it right, which is great. And Swingman, you are the winner today. So congratulations. Shoot me a DM on Twitter, and we'll go ahead and give you a signed copy of the Trader's Handbook once we have those available. So congratulations. Shoot me, again, a DM on Twitter. or email me at richard@traderlion.com and we'll get you set up. But congratulations and great work, everybody. I see a lot of people with the right answer. We'll go ahead and walk through the process. The first one, you've got $2,000 of risk here because 25K times 0.08. Then you've got 15K times 0.05, 750. 10K times 0.03, 300. 25K times 0.10, 2,500. And then you sum all these up and you get a dollar risk, which would be your dollar drawdown if everything was stopped out, of 5,550. And I rounded this up to 5.6%, but you basically do that number divided by your account value, and that's how you get your total open risk amount. So great job, everybody. Most of you guys got it right, and you should be able to do this math because this is the simple thing. This is the simple way to basically keep your risk in check and recognize, are we in a corrective environment under the 200 SMA, under the 21 EMA, and I want to be risking a whole lot less than this, or are we in a strong market environment and this is an okay amount, or I even want to increase my risk, maybe take up another position and get more invested. But this math and being able to calculate this total open risk is really key to treating this like a business. And, from a portfolio management perspective, being able to actually manage risk properly. So this is a good exercise here. And the three pillars that we can control this amount, if you think about it, are these right here. How many positions we have, the amount invested in each position, and the percentage away our stop/sell point is from the current price. And what's great about these factors is that all of these are elements that we can control and adjust based on our goals, performance, market conditions, market feedback, all of that. So I think it's really important to recognize, and it should be empowering to you, that all three factors right here, how many positions we take, if we take a new trade or not, the amount invested in new positions or existing positions, the percentage away we keep our stop loss, or how far, we're willing to, let the stock pull back before we sell it. All of these factors are within our control. So we have full control at all times of how much risk we're taking. So that's kind of the key point we want to emphasize here. So how do we lower that risk? Say we start a corrective environment like a few weeks ago. How do we lower the risk given that those are the three factors? Well, we can take less trades. We can decrease the total number of positions we have on our books. We can decrease the starter position size that we're taking on new positions, or the overall dollar invested. And we can tighten up the stops and tighten up the sell points, become more aggressive with selling, lock down gains, faster when we do have them. So these are all three different ways that we can go ahead and lower risk if we would like to. If the market environment shifts, market feedback, maybe 7 out of your last 10 trades have been losers, that's a sign that, hey, maybe I want to go ahead and lower risk. And these are all three ways that you can do that. And let's go ahead, dive a little bit deeper into each one. So how should you lower risk based on decreasing the number of positions? Well, one way you can do it is by grading your positions. So what you want to do is sort your existing positions by your profit or performance over the past month, and then grade your positions from A to D, taking this into account, as well as kind of your view on the potential of each stock going forward. So if the stock just broke out, it's still just pulling back to 21 EMA, it's a stage 1 base, early in a stage 2 uptrend, it might still have a lot of potential, especially if the market environment is still strong. So you would kind of grade that, A to B, especially if you have a nice profit in that stock. But if a stock, hasn't really performed much, it broke out and then just kind of stagnated, and there's other sectors, other groups acting well, that might be more a C or D stock, and those would be the first ones to sell if the market environment shifts or you just want to lower risk overall. So again, as you look to lower the total number of positions, start by eliminating the D's first and look to hold on to the A's if possible. Ryan, anything you want to add on this slide, or in general, these three pillars here?
I would say, one of the things is tighten stops is easier, said than done. Sometimes what happens is you go into this feedback loop where you tighten it too much, the stock comes back normally, and then you get stopped out and then it continues to rally, right? So each of these points that Richard's made, you should see it through a series of trades. And really don't think of it as I have to get it right the first time, especially when it comes to tightening stops and or selling into profit, or I sold at 5%, but now the stock is up 30 and I don't have a meaningful position. All of these things you will get better at each trade you place. Every time you sell early or you tighten up stock too much or you decrease exposure too fast because the market's, just coming back that one day, straight down 3.5%, 4%, and you've decreased too much, and then the next day market's acting like nothing happened, right? So all of those factors you will learn to pick up as you place more trades and kind of get repetitive. It's just reps again, right? Every trade you'll learn something, you'll tweak, it will build your experience and you get better at it. And it's not really about, perfecting each of these. It's something that, even now, sometimes or when I speak to Ross, hey, that day really shook me out because, we got too, I would say too bearish or too, um, we're playing defense too much because we let external factors influence what's part of our system. And that is still something Ross is working on after 30 years. And it get just, some trends you perform really well, just like basketball players. Some games they have 60 plus points, right? And they don't have 60 plus points every single game. So every market cycle that comes through, you'll perform good or great. In some market cycles, you're still doing the same thing, but you're not performing that well, right? So I think that plays a huge factor from a journey, getting better, building experience perspective. You won't be perfect every single day, and you won't analyze because there are other factors. You have a life outside of trading. There's internal factors of if you're, actually in the game, or you're just no matter what you're doing, you're in a bad spot as well. So I think the last one there with Titan spots, a lot of people tend to, try to get this perfect, scientific formula that doesn't really exist. So,
Yep, perfect. And I want to go back to the example for just a second because somebody pointed out you're not completely invested here. But the key thing here is that that doesn't matter for calculating your total open risk. So this account has 100K. These added up are only 75K. But that doesn't change how much total open risk you have because it's not based on how much you have invested. It's just based on how much you have at risk compared to your account, your total account value, not what you have total invested. So just want to clarify that point there. All right. So getting into the next pillar, decreasing the dollar invested, this is kind of how you can lower risk based on this factor. One thing you can do is consider selling portions of your positions to bring sizes back down to what feels comfortable in the moment. Maybe you have a winner that has run really fast, looks climatic. You can always sell half, buy it back if it sets up again. And what you want to do is look to preserve your strongest stocks first. But if the market does seem to be turning and starting a correction and a winner is extended from a base and is showing weakening signs, downside reversals, breaks below moving averages, breaks below trend lines, you can always sell half and look to re-enter when conditions firm up, maybe at the next base, maybe at the next pullback to a moving average. And just in general, if you're looking to lower risk, starting position sizes can also be adjusted down. And this is, progressive exposure, which we'll get into later on. But, as an example, if you've got a 100K portfolio and in general, you'd like to use 10K positions as a starter in a strong environment when the market is very choppy, very volatile, below moving averages. If you're going to trade, you could, instead of using a 10K position starter, you could use a 5K. And then maybe in the best environments when you're getting great market feedback, 5 out of the last 5 stocks has really worked. Things are still setting up, really firming up. You could then use a 15K start position. So you can kind of adjust risk up and down based on the market environment. And we'll get into a little bit more of that later on in today's webinar. So this is kind of what Rye was getting into, and we'll discuss some guidelines for both swing traders and position traders in general in terms of initial stops. But this is kind of how to lower risk with regards to this factor. So a strong market is forgiving. A weak market is the opposite. When conditions worsen, consider tightening up your initial stop losses a little bit and being quicker to raise them to your break-even level. I remember in 2021, this is an adjustment I made once a lot of breakouts were getting stuffed and not following through. So I would move my stop up to break even, a lot faster. Even this past December, this is kind of what I did as well. And if typically you moved your stop to break even at 3R, you can then do so at 2R. And you can also take partials faster. We'll talk about that in the next webinar. But basically, in this type of environment, especially a very corrective environment, each stock you buy has to prove itself to you that is worth the risk, worth the added total open risk. That's what's really key. And, during corrections, you want to be, stocks are basically guilty until proven innocent. In a strong environment, you want to give stuff the benefit of the doubt. And maybe, if you usually put your stops in, wait until the end of the day. If it undercuts it slightly and recovers, see if it closes strong, and then take it off if it doesn't. In a weak market, you want to act quickly and kind of shoot first and ask questions later. So that's kind of a little bit about how to lower risk based on stop losses and tighten them up. Then on the flip side, when market conditions improve, eventually the correction we're in will get better. We'll see. It might take some time. But when conditions improve, we do want to increase risk to make sure we're participating fully. And basically, you do the flip side of everything we talked about. You can increase the number of trades and the number of positions you have. You can increase the dollar amount invested per position or as a starter size, and adjust stops and sell points back to normal, to your normal system. So those are a few things in regard to both decreasing as well as increasing risk. Right. Anything else you want to add here just to sum everything up? And then next we'll get into setting stops and guidelines for both swing traders and position traders.
We'll tie a lot of this into market cycle as well. And number of positions. One of the first things is sometimes traders go crazy with 10 to 15 positions that they put on, and then you don't know which one's working, what's happening. It's almost like, you can't do 15 things at once. So highly recommend that you guys try to reduce that. Also, the number of trades that you place in a year, right? If your trades are north of 200, 300, 400, and you're highly active, and you're still, your numbers are not improving as you increase your frequency, that basically means if you actually reduce the number of trades in your decision making and make high quality decisions and not focus on frequency of decisions, it will result in better, just numbers overall. We always, want to be in every single trend and every single stock that's moving up. And the reality of it is you will miss nearly 80% or 90% of market leaders. And then the 10% that you do catch are the ones that will make any meaningful, difference to your accounts as well. So, number of positions that are open, the more you concentrate on a few. I like to do 3 to 5. 5 is, too much for me. I'm trying to get to 3. And then I'm focusing on making high quality decisions and picking, companies that are market leaders based on technical, fundamental, and whatever criteria that you want to define for them. In terms of increasing risk, it's also dependent on how much, open risk you can stomach. Some traders, say that, hey, if everything stops me out, I don't want to lose more than 2 to 3% of my overall portfolio. Some traders say, hey, I want to, aggressively trade, and they start at 5 to 7, let's say, percent. That's a little bit on, what your goal is, what type of stocks you're trading, if they're high ADR or low ADR type of stocks, and then what segment of the market you're focused on. If you're, focused on thematic runs like AI, cannabis, shippers, and these type of names, they're highly volatile, but they will move your account, both ways in a big way. Then you need that, up that stomach to kind of hold on when they really, really pull back. As well, because a 3 to 5% pullback or 10 to 15% pullback after a 70% run is kind of normal for those type of names. So all these factors we'll speak about, but I think the most important here is, don't go crazy with the number of positions, because then your risk management gets off axis and you're busy looking at the wrong things. You're busy looking at what's happening and, what's this stock doing, what's that stock doing, instead of actually managing your risk in the markets.
Yeah, perfect. All right, getting more into stop losses. I showed this slide in the previous webinar, but I think it's really worth emphasizing this way of thinking about it. Stop losses are your insurance. They're basically the cost of doing business. And analogy that you can, a way of thinking about it is, it's your ticket to actually buy a ticket to actually place a trade, whether you're buying Tesla, whatever it is. You're paying your stop loss in order to actually enter the trade and look to participate in a strong trend. And the best thing about this is, and way of thinking about it, is you get to decide exactly how much you pay by defining your risk based on the stop loss, as well as the position size itself. And sometimes, if the trade works in your favor, you even get your ticket back, you get a nice refund, as well as get to participate in the trade. So don't think of stop losses as a negative thing. Don't fear them, thank them. They're there to protect you if the trade goes sour and doesn't meet your expectations. And any experienced trader, like Rye said, will tell you that the number one rule is to cut losses short. And every single person in the Market Wizards book talks about risk management, risk management, risk management. They all have different ways of approaching it, especially depending on, the hedge fund managers, manage risk in a completely different way than we might. But risk management at its core is so important, and stop losses are key for retail traders. And I think this is really important as well. We can't predict the outcome of a trade. We don't know if something is going to be a win or a loser, but we can decide how much we're going to pay to try it, how much we're going to pay for this ticket, pay for our stop loss in order to have that insurance to make sure that, we don't get completely set back if the trade does fail. And, last webinar, in the previous ones, we talked about entry tactics that allow us to design our stop clearly, the low of the day, the higher low key level. And that is what defines how much you're willing to risk on any single trade. And we've got a nice graphic here. Again, these are kind of entry tactics. They allow us to define our risk within an overall setup, within an overall strong stock. You could picture this being a stage 2 uptrend. This is just a base within that. And then you've got a higher low break above this pivot before the base pivot. This is your entry tactic. Buying here, setting your stop at, the low of the day, low of the week, higher low, a moving average, whatever it might be. You've got a clear technical level that says the trade fails. And this distance between your entry point and your stop loss is the amount that you're risking. So here's a little bit more on this. What we really want to emphasize, and this is a key concept that Ross really emphasized to me, and I love hearing him talk about it: tight and logical stop losses. Basically, if your stop loss and the amount that you're willing to risk is not tight and logical, you're not buying at a proper setup at a proper buy point. And what we mean by this is that entry tactics allow us to place a tight and logical stop loss. They're frameworks that we place on the charts that allow us to define a clear technical level to enter and a clear technical level to exit if the trade fails. And a logical stop loss means that a violation of that level would signal that the setup / entry tactic has failed. If you're buying versus a moving average, a bounce off the 50 SMA, a lower Bollinger Band, a clear technical level, if it breaks back below that level, that tells you that that setup has failed for that time being. Maybe it'll set up again, but there's no reason to be still in that trade. So that's what's really important here. That's what the logical part of this means. That level, that stop loss level, should signal that the trade failed. So here we've got a breakout example. We buy through here. If it reverses back down and closes below this higher low, that's breaking the expectation that we were starting a new trend and continuing on with this higher time frame trend here. The next part of this is tight. If your stop isn't tight enough, then it's not really a proper buy point in the first place. You're not really buying at a spot where volatility is lessened, where we're expecting this nice resumption of the trend, reconfirmation. So basically what we'd like to do is the stop will limit losses to just a few percent. Obviously, this is dependent on the ADR of the stock as well, but just in general, we'd like to keep it within a few percent. And if you can't place both a tight within a few percent, as well as logical, meaning a violation at that level would break the expectation, then if you can't place this type of stop, then there isn't really an entry tactic. There isn't a real setup there. Wait and be patient, because they will set up again. They will allow you to manage risk at the next proper entry tactic. So this concept, tight and logical stop loss, is something you really want to internalize and always be thinking about before you make a buy decision. Always think about, am I able to place a tight and logical stop here? If you can't, likely you're buying extended after a stock has already moved from a proper buy point, and you just have to wait for the next potential entry. Ryan, anything you want to add on this concept, tight and logical stops?
Yeah, the more that you do this, the more success you will see. One thing that Ross has taught us, like Richard said, is if a setup is, a culmination of a few things coming together for you to define risk at the end of the day.
Yep.
And if you can't do that, then it's not a setup or a pattern or anything, right? Any trading pattern or any formation on the charts gets a name because you can define a stop loss along with the entry. Uh, but you know, the pivot point as well. So it's super important because we see a lot of beginner traders just come in to the markets, and traders turn into investors when they don't have a stop. The whole function of what they're doing changes because a stock that they bought at 440 is now at 30, and now they view it as a long-term investment. So if you be very clear that, you know, if you can't define your stop, it doesn't matter. I've missed many, many opportunities in the market because I can't define my risk, but I've survived long enough to see the other end of it where it's very beneficial to be trading that way, even if it means that you miss some trades along the way, right?
Yep.
Like I said earlier, you won't, you know, not every type of setup will fit your risk appetite or the open risk that you want to have in the markets. So not every stock will meet the criteria or, you know, be in line with how you want to trade the markets as well. So if a stock has a ADR of 8 or 9%, personally, I don't want to be trading those type. That's too volatile for me. 3 to 6%, 3 to 5% is doable. I've learned how to manage risk on those ones, and I'm more comfortable in those, right? And you may be different. You know, it's all about defining, you know, where you think the tight and logical stop is and what kind of open risk you can stomach and what kind of volatility you can stomach at the end of the day. But the main thing that we're trying to emphasize today is that if you're not placing stop losses, you're setting yourself up for failure, as we'll show in like a chart. As your losses get bigger, the percentage to get to even gets, you know, asymmetrically worse for you as the longer you hold a loser. So
Yeah, and there's a good question from Ankit in the chat. You know, and it's something good to talk about here. So say this is a pretty volatile name. It's got an ADR of 5-6%, you know, on the higher end of things. And this right side isn't quite tight enough for, you know, a VCP. You know, you can't manage risk within 3%. What you can do is then position size smaller. So again, there's 3 different ways that we control risk, and 2 of those are your stop loss and the position size itself. So if you want to trade and enter a name that is a little bit wider and looser, or just more volatile in general, but there's still a valid pivot point and setup, what you can do is just, instead of taking maybe your typical 15K position or 10K position, you lower that to 8K or 5K and still participate in that move if it's set up properly, all of that. So, you know, it's really important to remember that there's different levers that you can pull to manage your risk on individual positions, as well as you know, your total portfolio as well. And this is the chart that Ryan was talking about. This is why it's so important to keep losses small. You've probably seen a version of this chart, you know, quite a bit, but you know, it's important to reemphasize that losses work against you, and the bigger they get, the tougher they are to recover. And this is both from a portfolio level as an individual position level. You don't want to be a sore loser. Work the math, manually cement this concept psychologically, and you always want to set a max non-negotiable stop loss rule today, and make sure that you don't, you know, overcome that. And this column right here is basically a percentage loss. And again, this could be on a position or your total portfolio. And then this would be after you experience that loss, what you would require to simply get back to break even. So at 1%, you barely have to make 1% back to get back that 1%. 2%, again, very minimal more amount that you have to get back. Even up to 5%, it's very minimal. But then once you get above 7% and really above 10%, you can see how the deeper the drawdown on a position or your overall portfolio, the more you have to gain more to get back to simply where you were. So, you know, you don't want to be in this territory right here, especially not, you know, sitting through a 30, 40, 50, you know, 75% decline. We saw many of the prior 2020 winners in the 2022 bear market fall 60, 70, 80 plus percent. You don't want to sit through that. You want to have rules, stop losses, sell rules that protect you and keep you in this territory right here. Your first loss is your best loss. You want to keep your loss as minimal as possible, because then you just need 1 or 2 trades to get that back, just with some small winners. So this is a really important chart, and definitely if you haven't seen this before, take a screenshot of this, think it through. And the key point is the bigger your loss gets, the more you have to make back by quite a bit just to get back to where you were and to get to back to break even. All right. And the flip side, this is the financial component to it. You have to work a lot harder to make it back, but also taking small losses is mentally just, an easier thing to do. Small losses do sting. I won't say that small losses are fun, but large losses are devastating and really hurt your confidence, which is a huge part of trading. A big loss, you'll have to take a few days, take a week. If it's a really big one, take a few months off to really be right again mentally and be ready to get back in the game and, work your way back up to where you are. And executing well and taking a loss should build confidence. Losses, I take more losses than wins. My batting average is typically under 50%. And taking losses to me is just a matter of my system. It's just part of the process. And it actually should build confidence because if you're taking small losses, you're you're managing risk correctly. And even after many small losses, and this is what's key, even just one good trade can quickly give you back that renewed confidence. So if you take a 2% loss, 3% loss, then a 4% loss, even one 8% gainer, it might not get you back exactly where you were, but you'll feel sharp again. You'll feel ready to go and ready to participate in future trades. And this is the financial capital part of it. This is kind of an example with a 40% win rate. So again, losing 6 out of 10 trades. And you can see this is just an example of, maybe a section of your portfolio and 10 different trades. You've got a 3% loss, 4% loss, 5% loss, then a 10% winner, then an 8% winner, then -7, -3.5, -2, a nice 23% winner, a 6% winner. So only winning 4 out of these 10 trades. And the result is you're up 20% on that section of your portfolio. And again, your batting average was 40%. Your average win was 11.75%. Your average loss was 4.08%. Your win to loss ratio, which is your average win divided by your average loss, was 2.88. So you can see that even with only winning 4 out of 10 times, you have really strong performance. And again, this might be a section of your portfolio, but the goal is to do the same thing with your total portfolio. And over time, over the 12 months, just have, bigger winners than losers, keep those losers as small as possible because, optimizing for a very high win-loss ratio, a very small average loss ratio, that will allow you to build in failure and have your batting average be even, 30%. A lot of the top traders in the USIC, the market wizards who I talk to, their batting average is pretty low, 30 to 40%, but they get 200% returns, 300% returns because they let the outliers run, let those gains, trend for them. And just a few trades can really dramatically improve their performance over time. And the rest of the trades are basically scratches, -2%, -3%, -4%. And in the long run, their winners are much stronger than their losers. So small losses is almost more important than big gains, although big gains definitely help. And this is the aspect of trading that we can control, the small losses. We can control this pretty regularly versus the big gains will just kind of happen every now and then in the strongest market conditions, in the strongest stocks. And what's key here is you only need a few good trending winners can make up for a lot of paper cuts. And you just want to build in failure and expect to lose. Ryan, anything you want to add on this fact, batting average, or how effective keeping your losses small can be over time with your performance?
Yeah, there will be a lot of frustrating times where even the 10 out of 10 trades type of example, you just are stringing together losses. Now, just imagine that each of those losses were more than 7%. You're digging a bigger hole
Yep.
that you have to climb out of. Um, and it gets infinitely harder to do that because you'll need a ginormous winner to get you out of it all at once. And that's the mindset that traders start to take after they kind of accrue like a series of losses in a row. And that's part of the game. It's going to happen where no matter what you do, you're still not seeing a particular profitable trade, even if it's the same system or you're trading within the market cycle. and things are just not working out for you. And the only thing that could save you, where that 11th trade turns the tide is if you survive for that 11th trade. And then the only way to survive that is to keep them below 7% because you don't want to dig a deep hole uh, to climb out of, right? So a 2% loss, I would take any day of the week. A 3%, I get way too concerned if it's past, 3% for me. Basically, it tells me that the setup that I anticipated to work for me is not working for me. And I need to get out regardless of what the stock does after I sell does not matter to me because what I planned and how I enter the trade, the entry tactic that I used, allowed me to minimize my risk. And if a stock is not working in my favor, it's not working in my favor, and I have to just move on to the next trade. Is it a good feeling that you sell something and then you see it rally over the next few days? It's not the best feeling. Do you want to get back into that name? Yes, right away. But that creates, a loop, a never-ending loop where you'll start buying when you're not supposed to, you start selling when you're not supposed to, and you're trading off of emotions and not a system. So what we spoke about in the previous webinars with entry tactics, setups, the phase you're in, open risk, and all of these components come into play for you to be successful. And one of the most important ones is if you let your, losers get past 7%, you're mathematically at a disadvantage to be successful. So, maybe in the chat you guys could put, what your max loss is with your current entry tactics, what kind of, losses you're taking on average. If you know your numbers, you have to know the numbers that Richard's put up on this slide, your batting average, your average win loss, and the ratio of that. If you don't know these, you should probably not sign in, you know, take a cash position and look at the last couple of months and last couple of years and calculate these numbers because the proof is always there as to why you are successful or why you may not be successful. And this is the basis for everything, right? Now you will start thinking statistically. Some people do that because they have an engineering brain. Some people don't have an engineering brain, but just looking at the numbers will allow you to deliberately, be more patient when you have, a string of losses, or just be more patient with your winners because you know that your average winner, when you catch it early in a market cycle, tends to be that 10-15% range is not where you're supposed to take profits. So there are infinite number of benefits for you to be tracking these five numbers. Um, and we'll tie, the average win and the average loss into the market cycle webinar that we will do. And it's very beneficial and it keeps you really in tune with what kind of market are we in? A choppy market, a trending market, a market where it's supposed to be, directionalist is there's no direction up or down as well. And we'll be using these numbers in future webinars as well.
Yeah, and we'll show you exactly how to calculate this, and we'll actually be building it into the DV journal to calculate these for you, as well as the total open risk. So we'll make it really easy in DV, but until then, we'll show you how to calculate these manually in Excel. It doesn't take too long to set up. And like Rai said, definitely worth reviewing your last year of trading. Keep track of your batting average. How's that changed during different market environments? That can almost be a tell for you, as well as tracking your average win is really critical because, sometimes there's environments where things are just trending and really working, and then that average win will be increasing over time. And that average loss for me is actually pretty consistent even during those times. But tracking the average win and batting average helps me keep track of the current situation and environment. All right. So defining a stop loss, let's get a little bit into it. These are kind of the key steps. First, when you've got a potential setup, check your entry point and logical technical stop. Calculate the percent distance before them, or ADRs if you like to think about it in that way to account for volatility. Know the dollar amount of your portfolio you want to invest, and then simply multiply this dollar amount by your stop and check if you're taking up too much additional portfolio risk to take the trade. If the total risk is going to be 1% of your account, and you don't want to take that on a single trade, or you don't want to add that to your total open risk, then you either have to not take the trade, choose a different stop, or lower the position size. It's as clear as that. and you just want to investigate why it doesn't meet your risk parameters. But these are kind of the key steps to define a stop loss. So this is an example here. Say the entry here is around 100. The stop is at maybe the low of the prior day at 96.5. And you would just basically want to ask yourself this question: is this a proper setup? And here, if you can't manage your risk tightly and logically, you're not executing a setup. We just want to reemphasize that. But doing the math here, again, your entry is 100, your stop's at 96.5. That percentage risk is 3.5%. And say you want to take a 15% position, then you're risking just over, barely over 0.5% of your total portfolio. And that's kind of the sweet spot for me. Everybody's a little bit different. I like taking slightly smaller stops in this to get this more to 20%. But again, this is dependent on your experience, how well you can manage risk, how well you can pick good tight entry points. And we'll have some guidelines on position sizes later on in this webinar. But you can also think about it in total portfolio amount that you have at risk for any single position. But that's just a basic example of defining your risk on a single position on a single trade. So here are some initial stop guidelines, both for swing trading and position trading. For swing trading, you want to be a little bit tighter, a little bit faster, 1 to 3%, maybe 4%. Raise stop to break even 1 to 2R, especially, taking into account the market environment, maybe a little bit less during trending environments. And this is kind of key. And I think somebody will probably ask this in the chat, 1 to 3% is pretty tight. What about, a quantum stock that has very high ADR where it can move that in about 5 minutes? You just basically want to take that into account. And instead of, keeping it here, you can increase your stop percentage, especially if it's still technically valid, but just decrease your position size, because it doesn't take much to really move the needle in that type of name if it really gets working. So a small position size can still benefit your account. So with high ADR names, you basically just want to adjust these parameters. Basically this is kind of one ADR, and maybe for that, you move it up to 5-6% and then decrease your position size from maybe 10K to 8K and make that adjustment that way. For position trading, you want to keep it a little bit wider to give the stock benefit of the doubt. Your initial stop might be 3 to 5 to 6%, and you can be a little bit slower to raise your stop to break even 2 to 3R. And here maybe your stop is the low of the day on the day you enter. Maybe it's the low of the previous day. Maybe it's on an undercut and rally. Here it might be the low of the week or the low of the past 2 days, or the moving average. Ross really likes to use the moving averages as they're curling up the right hand side of a base as his stop loss, and that's how he likes to position trade. So depending on your style, swing trade or position trading, you're gonna have slightly different statistics. But for swing trading, you're gonna be taking tighter stops. But if we go back to the math, your average win is gonna be a little bit smaller because you're taking profits faster. Whereas with a position trading, approach, your average loss is going to be a little bit bigger, but your average winner, because you're going to benefit from those longer trends, month-long trends, is going to be higher as well. So both systems, both processes can work. Position trading is more for people doing this part-time, who maybe are working another job, while swing trading, you have to be a little bit more active and a little bit more aggressive as well. Ryan, anything else you want to add in terms of guidelines for stops based on the two different approaches, swing trading versus position trading?
I think you covered that well.
Cool. All right. Adjusting stops. So say, the trade is successful. It starts working. It pushes higher out of the pivot. When do you actually adjust that stop loss up? Basically, like I said, guidelines raised to break even around 1 to 2R for swing trading, 2 to 3R for position trading. And you want to kind of keep raising it as the stock makes progress for you, but you don't want to choke off the trade, as Mark Minervini likes to say. So you want to give it room to breathe, natural fluctuations. And what I like to do is as soon as the cost or the 21 EMA rises through my cost, so the stock is rising, the 21 EMA is rising, as soon as it's above my cost, then I'll transfer over to my longer term sell rules, 2 closes below the 21 EMA as my stop, and just kind of trail that, update it every day or every few days, depending on how much profit cushion I have. But just in general, you can trail your stop at moving averages, ATRs from the current price of the stock, SMAs, all those are valid ways, higher lows. You basically want to define for yourself how the uptrend is going to continue, when will it end, and basically put your stop at that point where the trend would end for your style, for your objective, for your time frame in the markets. Moving your stop to break even, just getting a little bit more into that. Again, this depends on your style. Swing traders should be quicker. Position traders can give it a little bit more room to wiggle. Guidelines, profit of 1 to 2 risk multiples. You can adjust your stop up to break even. And again, in faster markets, choppier markets where things aren't following through, very volatile environments, you can be a little bit faster with this. But you don't want to choke off the trade by moving it up too soon. You want to give it a little bit of room to work, because sometimes the stock might not break out the first day when you expect it to, but it might recover and re-break out the next day and follow through. So yeah, in choppy markets, just be a little bit faster with moving up to break even, and you'll kind of learn and gain a feel for this, when that's appropriate, when it's not appropriate, by going through different market cycles. All right, trailing stops. Again, depends on your style. We talked about this with relevant higher lows. One thing that I like to do as well is, if we get a move higher, a higher low forms a range, maybe it pullbacks to 10 EMA, and then it re-breaks out through that short range, I like to put my stop at the low of that breakout day. This is something I learned from Oliver Kell, called an ignite bar. When there's a massive candle that really puts in a statement day, it shouldn't break that low based on my style. So I like to move my stop up to just under that higher low. And again, you can use moving averages and higher lows to manage your risk, whatever kind of works for you and how you view the markets. And then one thing I think is really worth emphasizing here, use alerts. You can put alerts, early alerts as it's approaching your stop level. You can put it above moving averages, higher lows, so that you're aware of everything that's going on the stock. Excuse me. If you're working full time, you can still keep tabs on charts simply by using alerts, and that way you're notified on your phone or email or whatever when you actually need to go ahead and look at the chart. So alerts are free. Definitely go ahead and make use of them in your platforms to keep tabs on price, so you don't have to be watching the chart every single hour of every single day. All right, stops on multiple positions. This is a question we get often. This is how I personally approach it. Ryan, I want to hear your take on this as well. But basically, if I have an initial position, maybe I start a 10% or 15% position here, and then it pushes higher, pulls back to maybe a 10 EMA or 21 EMA, and re-breaks out, I might add 5% less than in my initial position here. But I kind of treat them as two different trades until it makes significant enough progress where, maybe we're all the way up here and it makes sense to kind of treat everything as one position. But, if this fails here, I don't want to move my stop up here too quickly and just get stopped out of here. So I want to kind of treat them as two individual trades until there's substantial enough progress, from that second buy point to actually combine them and move my stop as one for both positions. So this kind of depends on your style. I think there's traders I've talked to who do it both ways. But Ryan, any thoughts on this? How do you kind of go approach this if you have an add-on buy? How quickly do you kind of treat that as the same position and adjust your stops accordingly, altogether?
I always treat it, I would say, separately, not the same at all.
Mm-hmm.
Only when the 21 day moves above the average cost, once again, is when I will treat it as one position, because that is how I manage trades that are up, 20, 25% from my entry. But unless that happens, these would be two separate trades and two separate position sizes. The position size for entry 2 will always be lower than the position size for entry 1,
Yep.
just so that the math works in my favor. And I always keep them separate for the most part. So
Yeah. I see a question that's pretty good from Harish. Do you guys use broker stops or mental stops? I put stops in with my broker. I've talked to traders, USIC, top performers who do it both ways. Some do mental stops, some have stops from their broker. I personally I like having that safety net that know if, I lost, connection or something, I've got a stop loss in to protect me. But I know, for instance, Oliver Kell uses alerts and uses more mental stops, but he has that discipline. He knows exactly, what his risk is, and he's able to take that. So know yourself, know if you're able to use mental stops, know if you're better off using hard stops. I think probably everybody starting off is probably better off using hard stops from their broker. Ryan, do you actually use, I actually don't know this, do you use hard stops or you use mental stops personally?
no, I'm actively at the desk. If I'm going to be away on, vacation or away from my phone, that's when I'll configure
Yep.
stops because you never know with the markets. But if I'm around, I'm always looking on my phone as to what the
It's
market's
5
doing.
o'clock.
So for me, it's not, I don't, I know that, if you're working part-time, it's always good practice that you enter and then you place your stop. You may be in a meeting, you may be, out for lunch. You don't have time to access your phone while you're talking to your boss. Um, so in that case, I used to be in that situation myself. So stop losses were super useful then. And now it's just, I'm at the desk, so that's why I'm not placing them
Yep.
explicitly.
Awesome. All right. So this is another question that we're probably anticipating. What about gap downs? How do we manage risk here? Gap downs will happen. I've had gap downs that take out my stop and then they recover and then they go. But I think the key thing here is we have to manage risk in real time. A stock could just as easily gap down and keep going, and it breaks below the base and then it breaks a 200 SMA, and then again you're an investor when you should have been a trader. You got to take your loss when it's as small as possible. But just in general, I think gap downs happen less often than you think. During good markets, during this type of environment, it's a more volatile, it's more prone to headline risk. It's going to gap up and down. But in a strong market environment, these happen a lot less than we think. And what's important to realize is that these are negative expectation breakers. A gap down suggests that, people are selling and the short-term momentum, it's the downside. So, honor your original stop loss as well as you can. Think again in a series of trades, 100 trades, 200 trades, and preserve the majority of your capital and move on. It's okay. You're able to recover from a small loss. You're not able to recover from a 50% drop in a position where you should have taken the stop at 5% or 6% because it gapped down below your 3% stop loss. So honor your stops and just, take your small loss when you've got it. Then, of course, there's, you like this animation, Rye, an even bigger gap down. We just experienced this with the DeepSeek news. There are a lot of names that were leaders that were acting well. Gev, Nvidia, that gap down 10, 15, 20% in a single day. These will happen, but again, not as often as we think. We've got recency bias because it just happened. But again, this is just part of the process, part of trading, and you just got to kind of exit and preserve your capital as best as you can. You have to realize that the money lost in the gap down is gone. This is a list of a few, big gap downs that people may have experienced recently and over the past few years. And think to yourself, how would a trading champion handle the gap down? Would they take their loss and just move on? Or, would they, hope that it returns? And hope is not a strategy. We want to, we manage risk here and now. And this is also why it's critical to use our other lever, position sizing, to manage risk as well. We don't want to take enormous positions because a gap down could happen. A CEO could have a stroke and then the next day the stock could be down quite a bit. They could miss earnings. We want to take steps to manage our risk as best we can, both with our position sizing as well as our stop loss. And during a gap down, your stop loss isn't going to help you, but your position sizing is going to make sure that it's not disastrous to your account. Maybe it sets you back a few weeks, maybe even a whole month or two, but you're able to recover that. And again, we're doing this for years and decades. We're not trying to think, in isolation, this one trade is all that matters. We want to think long-term and, just take our loss when we've got it. Right. Anything you want to add here with experiencing gap downs, large gap downs, how you personally think about going through it?
Yeah, I mean, they will happen. They don't define your trading. That's why, wacky position sizes where you place 80%, so 50%, 60% of your account in a single position, especially when it's stocks and equity, right? These companies can report something in terms of guidance and things overnight that a technical chart will just not tell you sometimes. So when that happens, the core of your system, which is, don't place all your capital in one name, which can work at times, but if hit one of those CRDOs and overnight you're losing, 80% of your portfolio, then that's not the best either. So there's always two parts to the equation that yes, when you're right, you're portfolio will move up quite a bit. But when you're wrong, are you going to survive the next day, right? So that's what's most important is the longer you survive, the greater the chance of you having a profitable system. And once you have a profitable system, it becomes an income for you. The trading becomes a source of income. So um, we've experienced this. I've experienced this. The way I handle it is I sell. Um, if I own a stock and it gaps down 20% tomorrow, I'm not going to question why. I'm not really looking at the news to justify that it may come back. I don't tend to do any of that kind of stuff. I don't turn into an investor all of a sudden that now I'm holding these and it will come back in a couple of quarters. Because I'm a momentum swing trader, so I know that, I lost this one and I have to take it to the chin and I have to move on because that capital, it's not going to happen, 10 trades in a row. I'm not going to hit a CRDO or FSLY and NVIDIA or a DeepSeek type of situation. These just don't, they're rare. And the most important part is the position sizing of a single name can't define, should be so high that tomorrow you won't survive. That's the most important lesson that you'll learn out of these situations.
Yep. Awesome. So let's get into position sizing now. Again, another one of the levers that we use to manage risk. So first things first, you need a system based on your experience level. It's like, I've used this analogy before, but it's like going to the gym for the first time. You don't come out the gate and put 200 pounds on the bar and expect to not hurt yourself, right? It's the same thing with large sizes. And this is, I think, one of the big reasons why people quit is they size too big, too fast with no system, no risk management, and they destroy their account and blow up their account. You have to earn the right to size up, and part of earning that right is learning proper techniques, learning how to place stops, learning the proper buy points that allow you to place tight and logical stops. So you have to earn the right to size up. You don't want to just start off taking 50% positions, 20% positions. You got to work yourself up to that level and build up that technique first. More advanced traders, as we'll get into, can adjust based on the number of edges in play. So if a stock is higher potential, you want to contribute more of your risk to that name. And the less positions, I think this is also a way to almost manage risk, the better you can manage them. So it might be counterintuitive that, taking less positions is less risky, but the reason it's less risky is because you're still managing risk with stops and position sizes, but you can execute better on your plan on those names. And again, just want to emphasize, don't size up too fast. You got to earn the right over multiple market cycles that you basically prove to yourself that you manage the risk. You know how to handle gap downs. You know how to set initial stops, in your sleep, all of that. Don't size up too fast and set yourself, back trying to perform when really your goal should be about building process first. Position sizing with momentum. Again, you want to scale up as you string multiple wins in a row, listen to that market feedback, scale down as that market feedback turns negative. And very importantly, and we'll get into this really in depth in the market cycle webinar, trade feedback is the market communicating with you via wins and losses about whether your style is working in the environment. And we want to use that as feedback and, position size accordingly using progressive exposure. So here's getting into some guidelines here. Trade your biggest when the market is cooperative and within your system. Think about the periods where you've really moved your account big and strongly to the upside. Was the market above moving averages when that happened? What did net new highs, new lows look like? Define for yourself what a strong market period looks like, and then trade your smallest when the market isn't cooperative to minimize loss of capital. Thinking it back to this current correction that we're experiencing, we're below the 200-day, we're below the 21 EMA, and we're really volatile, high, big ranges up and down. Is that cooperative with the system that's trying to manage risk tightly with losses and focusing on stocks and uptrends? Not necessarily. So you want to position size accordingly to manage your risk if you are trading. And then stacking up probabilities, correlating the number of edges with sizing consistently. Again, we'll get into a whole slide on that. And Rye, I think you explained that really well. And then it takes time to experience and experience the trade size. Again, you're building that technique, you're building that process, your system first. It's not about, in your first 3 months, you can suddenly manage, 50% positions. You have to earn that right if you even get to that point. Some people are much more comfortable with 20, 30% position sizes. Pace yourself. Stage 2 traders can trade big size and win big, but then give it all back and lose big. They don't know how to position size correctly. They just know how to position size big. There's a fundamental difference. And you can have low volatility equity curve profile and size 25 to 30% or even more positions consistently. It all boils down to the entry tactics you use, how you build into that size, and how you manage risk on the entry area. And Ryan, I definitely want to hear your thoughts on this slide, because I think you explain it really, really well.
Yeah, so with position sizing, we'll tie this concept into the market cycle quite a bit, and how what we define as a cooperative market and what isn't one. That will become really, really clear for you guys, and will help you build that system in this webinar series where you're supposed to be completely out of the market February 21st if you look at the daily on the Qs, and you would have avoided any of the mess that we're currently in, because we're in a down cycle for the past 34 to 37 sessions now. So this one is, you will see a lot of benefit in stacking um, up different edges. The reason for that is that the market, if there are more positive factors at play, they're catching different systems. And when the same stock is on radar for different systems, there's more interest and there's more momentum or directional momentum to the upside in the market. So the most important is, traders always ask, what am I position sizing? Because they want to completely emulate or follow exactly what I'm doing, um, because they want the exact same performance and the exact same numbers. The reality of it is that if I place a 25% position and a trader that just started 3 weeks ago places a 25% position, both of us will handle it really differently when price moves up or when price moves down, right? So that's where the phases come in. You have to know the phase you're in. If you're following someone on social media or you're paying someone for a subscription, look into the process of how they're entering, how do they enter their names? Where do they place the risk? How do they come up with these names that they're looking at? How do they build a focus list? What's their process? But the position sizing part of it comes down to experience, right? If I place a 25% position and someone else, that started a month ago places that, we'll have two different results based on the volatility that name is seeing, and there will be two different outcomes purely based on experience and nothing else. So that's a fact. You have to deal with it. Don't try to replicate position size. It's a huge mistake that, in recent years that has been promoted, that you have to start with, at 30%. You have to have huge skin in the game for you to, that's one way of going about it, but it's a surefire way of reducing your success of getting to stage 3 and stage 4 as well. The probabilities don't align. It's almost like you start, driving and someone says you can only drive at 100 miles an hour to learn. Um, that's not going to end well, right?
You got started in a parking
The
lot.
probability of you being a good driver, that, the threshold's set and that you can only be good. You can only be great if you drive that fast. It will end up in a wreck and you'll wreck your trading career. So definitely keep this in mind. Don't try to, emulate someone else's size. Build it up. You will get there. And if you think that you can get there in a year, it's really not a year. It's 5 to 7, like we said, right? It takes, you know, multiple market cycles. The last 5 years, I would say, from 2020, if you started 2019 area, you've experienced everything that you possibly can in a span of 6 years now that the market can potentially throw at you. We've had the deepest corrections, we've had crashes, we've had V-shaped recoveries, we've had long, downward trending markets for 3 to 5 months in a row where they frustrate the heck out of you. We've had a solid uptrend in 2020 and last year. So you've seen all of that. And it's, you've built, you'll build yourself up to this type of sizing as well. The last thing I would say is, try to not see companies and trades you make as a lottery ticket to take you to, to promised land. It might work, right? A company just gaps up overnight and it might work. But it more often than not won't. So don't, 50%, I see 60% position sizing for single names. If traders are doing that they're playing with money that they're willing to lose. That's a whole separate game. But if you're looking to build this as a system, as a source of consistent income, you know that you have a market cycle system where you can aggressively make a lot of money and then be out of the market for a couple of months. Meaningful money, right? Meaningful dollars. Then stick, I would say, within these thresholds being your max. Above it, it gets quite scary and it's not scalable either. So,
Yep. Perfect. And then, yeah, you want to take this one as well?
yeah, so position sizing, um, the first point, is boost performance. If you position size well, what that means is, let's say we have two stocks. How do you gauge potential? You gauge potential based on the number of edges that you see on those two particular charts. If chart A has multiple edges and chart B doesn't, should you be allocating more to chart A or chart B? I would allocate more money to chart A because the probabilities of it, having more edges means I have more conviction, right? And this is something that I kind of, built for myself because I feel I have an engineering type of brain and a mathematical brain. And if I'm seeing positive characteristics on a particular chart and there's more on that chart A, mathematically, that chart A should succeed and have a bigger gain than that chart B. So that's why, you want to build that scalable system so that chart A gets more of your money versus chart B. The fourth one we'll cover in depth. We'll have a whole webinar on market cycle. And then the last one I was already spoken about. You have to tailor it to your experience, your risk appetite, your tolerance that you've built over multiple market cycles. You could start at 5% position sizing. Will it make a huge difference in your lifestyle and your trading in the first 3 to 5 years? Likely not, but it will allow you to stomach volatility a lot better. You'll build it, and then you'll be prepared in corrections, to be on the side and just sit it out and then deploy capital when it's super important to do so. So all of these things play a role. The most important thing on this slide is, if you position size based on the number of edges that you see, it's just like that losses chart that we put up. You'll see the stats on the other side as well. The more edges, the more higher your win rate will be because that chart just has better characteristics. So,
Yep. And then these are some guidelines for when we're in a trending environment, cooperative environment, we're above the moving averages. Some general guidelines that you can use. Stage 1 traders, max stop loss about 5%, number of positions less than 10, position size 8 to 10%. And again, if you're just learning, there's no shame in trading 10 shares, 1 share, even a much smaller account that you could trade. If you've got a 100K at your disposal and you're starting out, start with 1K, start with $500 and learn the process, all of that. With much less than your total portfolio until you prove to yourself and go through multiple market cycles that you can manage risk, enter the strongest names at the right time, and all of that. So this is kind of for stage 1 traders. Stage 2 traders, again, max stop loss recommendations, guidelines, about 5%, number of positions less than 10, and position sizing, you can increase that a little bit, 12 to 15%. And then stage 3 and above, you can get a little bit higher. But again, you have to earn the right. You build up to this And you, at this point, you'll kind of understand what works for you. Maybe you want to stay at 15% positions. That's fine, but you'll have built the process and build the risk management skills and system up enough that you can handle, this amount of size if you would like to. But these are just kind of some guidelines, some starting points, some reference points for you guys as you go through your journey. Progressive exposure. We've talked about this a little bit, and we'll get a lot more into this in the market cycle, market analysis webinar. Progressive exposure is basically the act of increasing or decreasing your total open risk and position sizing based on trade feedback and market analysis. You want to analyze the market indexes, leadership, and stock gauges, and recent trade feedback, and ask yourself, are you being rewarded for taking new trades? So you can look at your past 10 trades like we did. What's your win rate? What's the average gain over the last 10 trades? Is that in line with your normal stats? Is it better? Is it worse? And basically ask yourself, is the market environment good for my style right now? And then based on that analysis, adjust your start position sizing, your stop percentage, your activity levels, if you're even going to be taking trades. We're below the 200 SMA and 21 EMA right now. Probably for most people, a lot less is more. Cash is king, all of that. And also adjust your sell rules to be a little bit faster during more volatile corrective conditions. And then when the market environment improves, when we've got a fall through day, when we break it back above moving averages, when we break back into stage 2 uptrend, we can adjust accordingly and get back to more normal risk parameters. So example of progressive exposure, if we have a fall through day, if we have a break above the 21 EMA, however you define for yourself a new market cycle, you could take 3 10% start positions. And if you get good feedback, 5% gain on each, that's 1.5% portfolio gain that then can be used to finance new positions. Maybe that's 2 new positions risking 0.75% of your portfolio, or 3 more risking 0.05%. Of your portfolio. Basically the rationale is you've got nice profit here from these positions, and you can use that to finance new positions and new test trades. And again, we'll cover this a lot more in the market cycle webinar. Ryan, anything you want to add on progressive exposure, or just sizing bigger during strong periods and sizing a lot less during corrections like the one we're in currently?
No, I would just say, progressive exposure allows you to get in really effectively. Some traders feel that it is a little too slow and they want to put more exposure on quicker, but it caps your in choppy markets. It's super helpful in downtrends when you're thinking that the trend is about to reverse. You putting on that position, seeing how it works. If it's working, then you add more capital and a second position on, etc. is super helpful while you're building out a full system, right? It's almost like it's buying you time as you build experience. And progressive exposure, as you build experience, you build this gut feeling that the market's about to turn. It becomes a little less important, but the first 10 years of you learning the ropes of the market and kind of developing a feel, it's the best way and the best framework that was put forth by Mark Minervini, right?
Yep.
You want to gauge and get feedback. If you're getting positive feedback, go and place more trades. If you're still getting positive feedback, continuously do that until the market's telling you not to. So it's almost like a way for you to buy time without having the experience. So that's the framework that he came up with there.
Yeah. And then we definitely wanted to touch on this as well, and we'll cover this more in the market cycle webinar as well, but just thinking about risk from a portfolio level and talking about overall drawdown. Over here, we've got a chart of the Qs. This has been a pretty vicious correction, down 10% at that point, down 20+% at the lows. We bounce, we're maybe breaking lower again. And probably a lot of people have experienced maybe the biggest drawdown of their trading career during this period. So these are some guidelines that you can hopefully use to keep that drawdown to a minimum going forward. At 5% drawdown, have starter position sizes, sell your weakest positions, especially ones that are breaking below moving averages. At 10% drawdown, this is basically looking at your equity curve and seeing if it dropped 5%. This is the first one, 10%, the second level, 15% all the way down here. And as you gain experience on more stage 3, stage 4, you can be a lot faster than that. Because I definitely want to be much more, closer to this 10% possible drawdown if we enter a full correction, and even less than that, so I can profit from the next move higher. But this is kind of a good guidelines, rules of thumb here. So at 10%, no new buys, raise stops on existing positions, and 50%, just go completely cash and watch. Because a 15% drawdown in your account, it's definitely significant. It hurts a lot, but it's recoverable, right? And the whole point for these guidelines, drawdown rules, is to prevent a 20% drawdown, 25% drawdown, 30% drawdown, 40% drawdown. If you just watch, these growth stocks when the market tops and enters a significant correction, these former leaders drop 50%, 60%, 70%. And we don't want to be along for the ride. We want to participate during the uptrends and step aside for the worst of the declines. And these are some rules that can help you from a portfolio level, keep those drawdowns manageable so that you can participate and survive until the next uptrend. Right. Anything you want to add on this slide or about overall drawdown and controlling that when a correction starts?
Yeah, this is another risk control mechanism, right? Because traders tend to uh, start to like hallucinate or get these fantasies about things will come back, and then they don't. And then you put yourself in a bad spot. This one I think we picked up from Eve, right? Well, at least that's where when I read something that she was doing from the IPO masterclass, it really clicked for me. You want to have this. It's kind of like a circuit breaker system for the markets. You know how if the Nasdaq is down 7%, the circuit breaker one level will trigger. This is kind of a circuit breaker system for your portfolio. That hey, you're 5% off the highs. Something's not right. Maybe it's the market. So listen to what the market's doing, or trying to tell you. At 10%, it's kind of circuit breaker two. I know Mike Webster has this kind of system as well for portfolio drawdowns. This should be, this is a top level, portfolio management. The folks that are managing millions and billions are doing this. Active growth money managers are doing this. There's no reason for you to not do the same. It's just a simple circuit breaker system for you to get out of the market to avoid those deeper corrections as well. So
yeah, and this is completely separate from the position management rules that you should be using for the trades itself that you're in. This is just from a portfolio level. These are things you should do to make sure you don't have too large of a drawdown. So that's pretty much it for today. Just some key steps for managing risk. As you're looking at a stock and a potential trade, define if you want to take more total open risk, define the stop loss, the likely stop loss for that position, enter the stock. Right after you enter, place a tight and logical stop loss at a key level for your style. As the stock makes progress, you can raise that to break even. As the stock continues, you can raise that to in the money even and trail your stop at higher lows, key moving averages. You can sell to strength, sell to weakness. These are things we'll talk about in this next weekend's webinar, concrete rules that you can use for that. But this is kind of the framework that you could apply to any trade that you take. And the risk management parts happen right here. And that allows you to control your downside and, allow you to profit from that trade if it does work for you. Key takeaways today: risk management is the key to longevity in trading. The three factors that you can use to control open risk are the number of positions you have, the size of those positions, and the stop loss levels you set. Stop losses should be tight and logical based on your style. And with position sizing, you need to earn the right to size up positions. You have to experience multiple market cycles, go through that process, learn to manage risk, learn what a proper entry looks like before you can, size up and try to perform. Before that, it's all about building technique, building process, building a system, and learning to manage risk before that. So those are some key takeaways. Let us know your favorite one in the chat today, and we'll pause here for a few questions. And before we do that, I just want to emphasize that if you haven't already ordered your Trader's Handbook, definitely go ahead and do so. You can scan this QR code to go ahead and grab your copy. Everything we talk about in these webinars is expanded upon and explained in different ways in the handbook itself. And the last 200 pages of this are a full model book that you can use to study the greatest winners from the past decade, pretty much. So that allows you to, speed up your learning curve, learn what winners look like, all of that, and, place your entry tactics, study how they would work in those winners. So definitely recommend picking this up if you haven't yet. And if in the chat you've already placed your order, let us know if you already picked up your copy. And let's see what these key takeaways are. Circuit breakers, awesome. Let's see. Losers, average losers, 100%. Never lower stops, 100% agree. Never average down, for sure. SoCal, hey Mike, he ordered 2 copies, awesome. Very nice. Thanks, Philip. Appreciate it. All right, let's see. Right, let me know if you see any good questions that we should answer. And Dr. Wish in the chat, hey Dr. Wish, he emphasized never lower stops and never average down. Definitely very important concepts to remember. All right.
Yeah, I'm looking for questions. I don't see. There's one about how I manage positions and different type of accounts. I just have 2 accounts. I don't have 6. But I am buying. I treat them separately because they have different objectives. Um, I tend to treat my personal trading account as a pure momentum swing trading, and then there's a tax-free savings account in Canada that I have, which I treat a little differently. So it all depends on the objective of the account, but I don't buy positions that are meant for momentum trading for investing. So there's no crossover. Why not average down, Richard? That's one of the questions.
Because the market's giving you feedback that the trade is not working. So why would you add money after it's already told you you're wrong? I would much rather just exit if my entry tactic fails, and then once the momentum goes back in the way of my trade and there's a new entry tactic, jump on the next point. If you enter if you try to average down, all you're doing is hoping. There's no system, there's no process, and that's not a professional way to approach this and to trade. So we're thinking in 100 trades, 500 trades, 1,000 trades, 10,000 trades. We're thinking in a long series of trades that will make over a career. Not that this trade needs to work and I need to force something and make it do something it's not doing. The market doesn't care what you think. If the stock breaks below a pivot after you entered, it's telling you that pivot failed and that entry tactic failed, and just step aside and wait for the next setup. There's no real logical reason to average down in a stock for our objectives for swing trading, for position trading. That's kind of how I approach it. And any additional thoughts that you want to add on that?
Yeah, pretty much the same. The reason you would average down when it comes to swing trading would be purely out of ego and thinking that you can make a stock do something that it's not clearly not doing. The next question, it was how do you deal with drawdowns? So dealing with drawdowns is mostly you either have to take time off, you have to step away, you're doing something. If it's I'm a high believer in system, and if you have a system that you're executing, that system will tell you to step away because things will not work. As humans, we deviate from that and we try to muscle the markets into doing what we think it should be doing. That's deviating from your system, right? So you learn those lessons along the way, but the best one that I've found is if you have a series of trades that are not working for you, you're doing the same thing that you were doing before. It's just the market's telling you now is not your time. You have to sit this game out or this market cycle out and be, ready for the next one. How do you use shorts or hedges to balance your long side exposure? That's the next.
Yeah, I think I forget which trader I heard this from, but they basically said if you feel like you need to hedge something, it's just a reason. It's a sign that you should sell. Sell at least some. There's different objectives, right? There's people who are looking to hold for years, and they try to they hedge before earnings. They hedge as the stock is pulling back to the moving average. That's not my game. My game is to step aside when a stock starts pulling back meaningfully. So, that's how I do it. I think, I'm not a professional in terms of hedging and all that. But when a stock starts pulling back and breaking structure and breaking trend, I step aside and either enter when it starts going back up or just go on to the next one. I don't know. Anything you want to add there?
Hedging at scale, like at scale when you're managing millions and have a really large portfolio makes a lot of more sense. If you have a portfolio that's small, it, in my opinion, is a waste of time. You're just trying to keep busy, trying to approach everything that, hey, I can't have a pullback. I need to be in a winner at the same time. It's a like just conflicting. I think experience makes hedging a lot easier. If you want to hold a winner with large size over multiple earning cycle and you're managing, large amount of capital, it's good. And it's actually kind of needed for you to sleep at night. But at small scale, I think it's just a distraction. You should concentrate on building a good system, and be a very directional type of trader, pick a direction. In the markets. So
Yeah.
there's another question, really good one. Can win rate be misguiding since market conditions are such that you take trades but losing them? Did I read that right? Can win rate be misguiding since market conditions are such that you take trades but are losing on them? Um, I Richard, you want to make
I'm not quite sure what he was asking.
can you
Can
spell
you
it
rephrase
for me?
that? Yeah, no problem.
Yeah.
And one thing I want to say quickly while people are entering more questions, which please do, guys. Hopefully, every person here enters at least one question. Um, Part of risk management is really what we'll talk about in the market cycle webinar, where keeping track of that market cycle is kind of really good defense and offense that allows you to trade in tune. There's times to trade, there's times to be completely out of the market, and there's times where less is more. So keeping track of the market cycle, are we above or below moving averages on the indexes? How are leading stocks performing? Are there even leading stocks in the market? All those are clues that will help you manage risk by not trading and not entering a market where the odds, the probabilities aren't with you. So, currently, again, we're in a correction. We're below 200 SMA, back below 21 EMA. Less is more in these type of situations, and a market cycle system will help you identify that in real time, so you can participate during the good times and limit the damage during the bad times. Let's see here. Does the handbook cover how to build focus lists with good potential winners? How to build scans? Yes. There's an entire chapter on screening and routines, and we'll be doing an entire webinar expanding on that, sharing a lot of scans that we use to identify winners, and also just talk about the process as a whole, the process of scanning and building a wider list, narrowing down the focus list to a few names, and then even narrowing it further to the names we actually want to trade. Because we get a lot of questions about how to actually build a focus list, a final focus list, and narrow it down, because I think that's something a lot of people have an issue with. So definitely we cover that in the book, and we'll do an entire webinar on that as well. Let's see here. Consider current market condition which is not conducive for breakout trades. Do you take trades when setup appears and failed, but keep trying? I think they may improve. So during very negative corrections, breakouts will not work as effectively. So I try to find earlier buy points or even pullbacks if I am placing trades, and always have a clear spot where I can get out quickly. And again, guilty until proven is innocent when conditions are like this. Bob asks, what are edges? Go ahead and watch our edges and setups webinar. We did an entire webinar on that and cover the edges that we look for, like relative strength, the end factor edge, all of those. So definitely watch that webinar. Right. Any last bits you want to say before we call it today?
No, I think the key takeaway from today is have a max stop loss. Look at that chart where after 7% things go downhill. Make that decision to have that. Know your open risk and know the basic stats that we spoke about and have a circuit breaker system. I think if you do one of those things from today's webinar, I think you will be a better trader over the next year and forever, because risk management is not optional. You have to do it for you to be successful for a long span of time in the markets.
Yep, perfect. Well, thank you, everybody. Appreciate the questions and your attention. Thanks for tuning in. If you enjoyed this, please go ahead and leave a like down below on the video right now on the stream. Definitely appreciate that immensely. Subscribe as well if you're new. And if you haven't yet, definitely go ahead and order your copy of the Trader's Handbook. It's coming out pretty soon now, just in about a month. So definitely go ahead and grab your copy to make sure you have it as soon as it comes out. And we've got a lot of upcoming news surrounding the release of that. You'll want to pick up your copy to make sure you get exclusive bonuses and resources as well. So definitely grab your copy if you haven't yet. You can just scan this or click the link in the chat or description. But thank you guys all for tuning in. Definitely appreciate all the questions and great engagement as well. So thank you all, and we'll see you guys in the next one this Saturday. So we'll stay on the lookout for an email about how to register for that, as well as the link. So thank you guys all very much, and we'll see you guys in the next one. Cheers.
Thanks, everyone.